Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss stock market rally Broadens, Social Security Taxation, Black Friday shopping, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Doing well. Yep, just getting ready for some turkey this afternoon. So turkey and football.
Yes, sir. As of this recording, of course, we are actually doing this on Thanksgiving. So happy Thanksgiving to you and to all that are listening. Of course, you'll be getting it after the fact, but we definitely hope you had a wonderful day with loved ones. And we got great topics we're going to dive in here. Stock market rally Broadens. This is always interesting. I mean, we've touched on this somewhat in the past, but the U.S. stock market appears to be following a similar pattern to past years, including last year. We see this pattern where large company growth stocks, which are connected, we've been talking a lot about with the AI technology, we're seeing that happen again. So a repeat seems to be prevalent here.
Yeah, we've been seeing this pattern where the first part of the year kind of has one theme and the second part has a second theme, right? Mm-hmm. And it seems to be playing out again. Now, just so people follow, I'll define the terms. So, the stock market can go up in a lot of different ways. And when it's a very narrow rally, that usually means it's a relatively few number of stocks that are leading the market higher. When it's a more broad rally, that means there's a lot of stocks participating, right? So, you can have a situation where you maybe have very few stocks doing well and a lot of other stocks maybe not doing much. That would be a narrow rally. But if all companies are going up a little and pulling the market up, that's more of a broad market rally. What we've seen the last few years is the first half of the year, really led by, fairly few number of really big companies. And that's what's pushed the market up. So as you said, whether that's companies linked to artificial intelligence or, last year, the talk was the Magnificent Seven, right? Which of course all are somewhat linked to artificial intelligence investing, but it was those, seven biggest companies that did really well for the first half of the year. And then what we saw in the second half was the market participation broadened, and you actually had a lot of these other companies that hadn't done as well early in the year, play catch up, to those fairly small number of companies that did really well through the first part of the year.
Yeah, well, and just to clarify again for people, the Magnificent Seven are Apple, Amazon, Nvidia, Tesla, Google, Meta, and Microsoft. But you're also, as you're laying out here, and we have talked about, we're seeing that trend with the midsize and the value stocks, and maybe why is this? Why is this broadening? Is this been a long-term pattern? I mean, have we seen this over the last decade, last 2 decades, last 5 years, or is this seemingly a newer trend?
Well, when there's a relatively small number of companies, really creating the market gains, I mean, their price has to go up quite a bit, right, to move the market as a whole. And, in a lot of cases, their price will be going up faster than their fundamentals can support. And so, there's going to be this pause where maybe they don't necessarily go down in price, but their price kind of trends sideways while, the fundamentals continue to grow, right? While they continue to grow sales, earnings, cash flow, all those things that you're looking for as an investor so that they don't get too far ahead of themselves. Meanwhile, on the other hand, you can have this broad group of stocks that aren't really participating, but we're seeing positive economic growth. They're seeing positive earnings growth, right? Those companies are actually looking more attractive over time. And eventually the fundamentals look really attractive. The stock price hasn't moved and investors say, hey, maybe I should rotate into that area. And you see more buying there. I think kind of the way you could look at the market is a lot of these, growth type companies, really their stock price is going up before their fundamentals, right? Their
Mm.
stock price is going up in anticipation of this improvement in fundamentals. Whereas when you get to the small and mid-sized stocks or a lot of the value stocks, the value side of the market is kind of the other way. The market wants to see them prove it and see that they can, grow sales, grow earnings, grow cash flow. Then the market will reward them. So it's kind of the first half of the year, these growth stocks are moving up in anticipation of them having a good year. And in the second half, the value stocks or the smaller mid-sized stocks are going up as a reward for having already executed at least for the first part of the year. And I think the expectations of that growth rate will continue at least through the end of the year.
Now, is there a situation when we have this kind of rally that there? The one thing I've learned by doing this with you, we've been at it for a decade now, doing the Plan Solutions Incorporated podcast, is a correction is always coming of some kind. Is this a situation where we kind of have to keep an eye that yes, this is a positive sign, but there will be a correcting, and that doesn't mean a huge dip in value, but there is one coming where eventually the market sets the actual value. I don't know what wording I'm trying to use. I hope that makes sense.
Yeah, yeah. I mean, there's always a correction on the horizon, right? And the question is always, is it a correction? Is it a bear market, right? I mean, what do
Mm.
the big pictures say? And so actually, the broadening of the stock market rally is a positive sign from that standpoint, because let's say we had a given year where it's mostly a small number of growth stocks that do really well and lead the market higher and have really strong returns while the rest of the market's not participating. That would be more of a sign that maybe the broad economic growth is not that strong, right? And because these other companies are just not being rewarded and they're not seeing earnings growth, and it's really, more speculators piling into this, relatively few number of companies based on these big expectations. And if that continues for too long, typically what you then see is those high flying growth stocks, seeing a big correction and bringing the market down, was the value stocks maybe a little more slow and steady, but not show those high returns, but then also not the big declines. I mean, we saw that in 2022, right? Where the growth stocks, the Magnificent Seven was down 40%. Growth stocks in general were down over 30. Value stocks were only down about 10 at the worst. So they didn't need as much of a correction because the price didn't get way ahead of the fundamentals in terms of anticipating future growth. So that's a scenario where a narrow, rally can lead to a bigger correction, right? But when you start to see the rally broaden and you see other companies start to, participate and maybe not put, so much of the burden on a fairly small number of companies to lead the market higher, that's actually a good sign that broadly the economy is doing well. The business environment is good, and that a lot of companies are participating and maybe not needing to go up quite as much in terms of a given company to push the market higher as a whole.
In a situation like this, are there psychological factors that are coming into play? Just the mindset of maybe people now, maybe some optimism as the economy starts to improve. Factors like that when we see an adjustment like this occur.
Yeah, and I think it is partly psychological. And if you look at, historical, it's kind of the difference between like the smaller do-it-yourself retail investor and the more institutional investors. And I think what you see is, a lot of the institutions will move into, these stocks that look attractive. They'll have a really good first half of the year that will make headlines. Maybe the person that doesn't follow the market as closely or maybe isn't as knowledgeable will say, oh, wow, look at how much this stock has gone up. I need to buy some of that, right? And they'll start piling in late in that run up, right about the time that the institutional investors are saying, okay, we've made good gains here. This probably isn't sustainable given the earnings growth and sales growth and things. It's a little ahead of itself. So they start taking profits and selling out of those kind of high flying, becoming household name type stocks, and moving into these diamonds in the rough that no one's talking about, right? No one wants to buy the fertilizer company or the garbage company. That's not going to be discussion at Thanksgiving dinner. It's going to be, the semiconductor or the AI company or something related to cryptocurrency this year maybe. Those are the things that people are going to be talking about, and so it has that of kind of pushing that newer marginal investor who may not necessarily be looking at these bigger trends and the timing of making those decisions. And I think that rotation is often driven by the big institutions, including pension funds, insurance companies, things like that, that are going to be more disciplined in terms of their long-term investment outlook and their strategy versus people piling into these hot names that might realize there's they're piling them in because they're hearing about them. The reason they're hearing about them is the price has gone up so much, and if the price has gone up so much, maybe it's starting to hit that short-term peak.
Mm. Well, and like you point out, I mean, they are the attractive names. Like, I invested 20,000 in Apple. These are names that people know, not usually, Jimmy's fertilizer or something along those lines. So, I'm sure that all plays into it.
Yeah, and it's tricky with some of these different names because you sit down and you say, okay, well, what do they really do, right? And the average person doesn't really understand what they do, how they make their money, and there is a certain level of mystique around that, right? That it's just kind of magic how they can post these strong performance, but it also makes it difficult for the average person to really assess what's a fair value when it's a business that's difficult to understand or on the leading edge versus a lot of these value stocks. I mean, it is pretty simple how they make their money, right? Some of these are companies or industries that have been around for decades, if not hundreds of years that continue to produce. And there's a point where if they're just not really participating in the market, you start to look around and say, hey, there's these agriculture companies, the companies that are just doing the basic things of supplying our food that obviously need to happen. And if they haven't, if their stock price hasn't gone up, but their fundamentals continue to improve, they actually start to look pretty attractive. And a lot of times people are surprised when next thing they look and they're saying, wow, that's a really good return for this company. What do? Oh, they produce eggs. It's like people wonder, like, wait, how does the company that produces eggs return over 50% in a year? And I say, well, do you buy eggs? I buy eggs. Like, we're still buying.
Yeah.
So there's that opportunity and often a little bit more of a margin of safety, right? Because these are not discretionary type purchases, and even if the economy went through some tough times, I mean, how much is it? How much is their business activity really going to go down when that's maybe one of the last things that we would cut back on if money got tight?
Yes, absolutely. How would you like to put a button on this section here?
Well, I just think what we want to point out is really just the importance of staying disciplined, right? And I think this broadening of market participation that we're seeing, as segments that have lagged earlier in the year are now taking over leadership and playing catch up. It really benefits the investors who remain consistently diversified and knew not to chase those hot returns, but rather say, okay, these returns have been really hot. That's great. I participated to some degree, but I'm going to also make sure I maintain exposure to these other areas that maybe look more attractive and will possibly produce better returns in the future.
Let's jump into Social Security taxation. This is something we've touched on slightly before, but the fact that many people are surprised to find that their Social Security benefits are taxable at the federal level. And then state rules, of course, accordingly, depending upon your state. What do we really want people to understand when it comes to receiving your Social Security benefits?
Yeah, this is always a really tricky area when it comes to tax planning, because people receiving Social Security don't realize there's kind of this, I don't know, kind of bending of the curve in their tax levels, right? That's not just based on their income going up and their tax going up proportionally, but it can actually have a a bigger impact because of the rules around Social Security. So as you said, Social Security are taxable at the federal level, but those tax rules depend on the person's total income.
Hmm.
So if your income's very low, you don't pay taxes on your Social Security. If your income's very high, the maximum amount of your Social Security that counts as taxable income is 85%. So worst case scenario, 15% of your Social Security would be tax free. And there's reasons for that. It's kind of complicated. I don't think we need to go into it. But because it's taxed on this sliding scale, what happens is you hit a point where as you earn additional other income, it will start to make more and more of your Social Security taxable. So actually, the tax that you're paying, your effective tax rate, is higher than your marginal tax bracket. So for an example, someone who's in a 12% tax bracket, at the very beginning, when Social Security is not taxable, they may make a little extra income and just pay 12%. Okay, not a real high tax rate. But once they hit this inflection point, and they're earning additional income, not only do they have to pay tax on that additional income, they now have to start paying tax on Social Security income that they were already receiving, right? So they're not getting additional income, but they're being taxed on additional income. So that really can turn a 12% tax rate where it has an effective rate of 18 to 22% because they're paying taxes, and then their taxes are they're paying taxes on income that otherwise would have been tax free, in addition to the marginal additional income that they're bringing in. So it really is important to really sit down and do the tax planning and say, what's the real cost here? Because in some cases, someone might want to say, hey, maybe I should do a Roth conversion. I'm in a low tax bracket. And that may be true and it looks pretty simple, but actually, if they start looking at the real cost of that Roth conversion, it's much higher than that 12% tax bracket, because claiming additional income is going to make more of their Social Security taxable. So they're actually going to pay a much higher rate on that Roth conversion.
Is this the reason this occurs? Kind of similar to a situation where, let's say, someone is employed, not an independent contractor, but employed by two different entities. You and I have had this conversation privately that sometimes that doesn't really lean well when it comes to taxes because they're not calculated together. Is that what occurs here? Is it that it's looked at as two different revenue sources? Thus, when your income level is raised, that's why the taxation gets higher.
To an extent, I mean, it
Okay.
really is, yeah, applying different rules to different income, which we love to do in our tax code, right? You can have ordinary income that, wages, pensions, retirement, IRA distributions. You can have income that's, taxed on a sliding scale like Social Security. You can have, capital gains and qualified dividend income that's taxed at a preferential rate that also, can depend on where you are in the tax scale. I mean, you can, if you're low enough in the tax brackets, you pay zero on capital gains and qualified income. Once you go over a certain threshold, you're now paying a 15% rate. So yeah, it's related to different income and different rules for different income. Really what I think it is here is it's just part of our progressive tax system. It's just, we already have a progressive tax system, whereas your income goes up, you pay, a higher tax rate, right? But in a way, Social Security, when you're in that little bubble of income range, it's our progressive tax system on steroids, where
Hmm.
it goes from, okay, you're low income, you pay a very low rate or maybe zero. But then suddenly, okay, now you're middle income. Now we got to catch you up to where you should, to where you should be on those progressive rates. And it creates this kind of bubble in the tax curve that, can be quite costly for middle income, which, you can argue maybe doesn't make a lot of sense, but that's just where the tax rules are now.
Yeah. Anything else you want to add before we move to Black Friday shopping?
Well, again, just stressed, these days, I mean, using software to run the numbers is just, it's such an advantage, and it's really needed because there's just so many different moving parts based on the different types and sources of income, as you said.
Hmm. Yeah. All right. The Black Friday. Well, as of this recording, Black Friday is tomorrow, but you may have already done your shopping. But we're going to discuss it anyways because I always think it's an interesting topic, and you folks did such a great job of writing this section here. Uh, yeah, really, what do we want people to understand? I mean, there's so many different retail options, be it online, in person, etc.
That's right. Yeah, Black Friday tomorrow, obviously. Then there's Cyber Monday, and then there'll be something else and something else, right? As retailers try and get as many dollars this holiday season as they can. And I think it's important for people to shop smart, right? I mean, Black Friday is popular because of some of those big deals that are offered, but we know a lot of those deals are just to get people in the store, so you can then sell additional higher markup items, right? And so it's understanding that, and once you're in the store, saying, okay, well, does this make sense? Or looking at a lot of these kind of Black Friday stores that really promote it. Then you have like some of the the different membership stores, right? Like Costco or Amazon Prime or Target Circle or the Sam's. I mean, all of those. In a lot of cases, some of the membership are not as promotional, but may still offer better options or better prices. So weighing those versus the ones that spend a lot more on advertising to get you in the door. I mean, granted, they obviously have an expectation they're going to recoup the cost of that advertising somehow. Um, I think there's also a lot of cases where, it's been documented that there's kind of these, fake sales where, company, they don't actually mark down the retail price. They mark up, say, normally it's this higher price and this, new sales price is actually the normal price it's always been. And they know that often will, kind of get those quick purchases, people thinking, oh, it's on sale, I better pick it up. But really, they're buying it at the same price that they could normally. It's a little bit deceptive. And then other companies where they have different prices in store versus online, right?
Yeah.
And so you go into the store and you say, oh, look, this is on sale, I should get it. You don't realize it's actually going for less online, where the market's a bit more competitive, a little bit easier for people to quickly do comparison shopping, and so they have to bring those prices down to try and get those sales. A little bit harder to see that when you're in the store, but most of us have these handy dandy supercomputers in our pockets that gives us the option to maybe look and say, oh yeah, okay, there's a better sales channel that I could use to purchase this.
Yeah, absolutely. And I know it's not included in here, but one of the things that we'll converse about on here, and you and I in person, is for this time of year, setting a budget and sticking with that budget. A very vital thing. It's I've had a few Christmases in the past until I really got disciplined with finances, where I went, wait a minute, where did all that money go? Oh yeah, I just went and bought. I didn't have a budget, set a goal, and know exactly what it was going to be. As a matter of fact, I'm well under my Christmas budget this year. I'm very proud of myself.
Yeah, yeah, no, absolutely. I'm well under my Christmas budget just because I refuse to do anything Christmas till after Thanksgiving. That's a big sticking point for me. But yeah, no, that's absolutely the case because I mean, so much of the advertising, these different pricing thing, it's all designed on the impulse buy, right? To get us
Mhm.
to just say, oh, okay, well that's on sale, I should get that, or that appears to be a good deal, but maybe it's not such a good deal and maybe it doesn't fit within the budget and it's just not something that's necessarily needed. So yeah, anything that helps bring that financial discipline obviously can pay big dividends.
Absolutely. All right. Well, let's jump over to the Plan Solutions Incorporated office bulletin board. We've got a couple items pinned up there, Mr. Armour. Let's start with when the office staff and yourself will be on vacation.
Right. Yeah. Yeah. So this is a kind of our annual just notice of holiday schedule. So obviously we're talking here on the 28th, but the office is closed. We also typically close the following day, so people have time to travel, make it a 4-day weekend. And then this year it'll be kind of a weird year in terms of where the holidays close. So we're going to be closed on December 24th and 25th, and of course January 1st, which is the typical New Year's holiday. And just give everyone our annual reminder, with the holiday schedule, and then of course, the schedule of a lot of the companies that we work with, right? And obviously, their people are going to be taking time off. So we always want to try and get those year-end requests, forms, and things completed as soon as possible, right? We don't want, big backlog of paperwork that we're trying to submit on the last week of the year. Because it's always a little tricky. You just can't guarantee that it's going to get completed in time. In a lot of cases, it's due to factors beyond our control, right? It's other companies and the level of coverage that they have, and we may not be the only company that's submitting a lot of paperwork at the last minute. If everyone's doing that, then they just may not have the bandwidth or capacity to be able to process it all. And when it comes to tax planning and some of these things need to be done, within the tax year. So it's best to try and get it done, several weeks ahead of time rather than wait up until that last kind of partial week of work that we're going to have.
Yes, sir. Anything else you want to add before we wrap up this edition of the Solutions Incorporated podcast?
I just hope everyone had a great Thanksgiving, and one pretty much down to 1 month left to the year, so time's really flown. But it's been a good year, so that's nice. I guess that's something we can all be thankful for.
Yes, sir. And we thank you all for listening to the podcast, either on Apple Podcast or Spotify, where we ask that you not only subscribe if you haven't already, but leave a rating and a review as well. Or you can follow along on YouTube. Yes, we have a YouTube channel where you can follow along to the Personal Financial Review, the written content that we discuss, and listen to all the content there just by going to youtube.com/@plansolutions. And if you want to get subscribed to the Personal Financial Review, send Katie an email and get subscribed today. It's katie@plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.